G'day guys, and welcome back to another installment with the iBoot Investor. Today we're going to follow on with part 3 of the Infinite Money Loop, where we're going to dive deep into how you can maximize your tax effectiveness using different structures for the sale of assets or income that assets produce into your portfolio. Before we jump in too far to the video, I must run through the disclaimer. The information provided is designed to be entertaining and general in nature, and it is not specific to any of your circumstances. I highly recommend that you consult with your own legal, accounting, and other financial professional advisors. So in the first video of this Infinite Money Loop series, we looked at the 4 main types of structures. The first one being the individual, then the second, the partnership, the third, the trust, and the fourth is the company. We broke down the advantages and disadvantages of each of those structures and how you can use them to better service your investing needs. In the second video, we looked at how you can use these structures in order to maximize your purchasing power for real estate. So that was which structures give you the best leverage to be able to purchase the most amount of real estate. As you all know by now, I am a huge proponent for positive cash flow assets. When it comes to tax, any monkey can purchase a piece of real estate or an asset that loses money over time, reducing your overall income for the year and therefore reducing your tax. But you don't actually progress unless that asset increases in capital gains greater than the loss that you're making from the income. Now, this is not, as we've discussed in many of the videos that I do, a sustainable method for investing. Having said that, you can purposefully use structures to help you minimize your tax bill and maximize your personal income. With today's video specifically, I want to take a look at the effect of a family unit. When 2 people together in a marriage or a partnership are investing for their future. And how does it affect the household income when you're purchasing assets in either the individual, as a partnership 50-50, in a discretionary family trust, or a company. Before we jump into the examples, I want to run you through how a discretionary family trust can distribute your income or profits for the year from your investment to maximize the tax effectiveness. If the trust owns a piece of real estate or an asset that provides a profit for the year, whether that be through a sale or an income, the trustee of the trust has the ability to distribute the profits that that asset provides throughout the year throughout the family unit that can best maximize the tax effectiveness. Typically, what you want to do is provide as much income to the lowest income earner such that the 2 incomes of individuals in a family unit equal each other. The reason you distribute to the lower income earner is because they may be on a lower tax bracket. And if you provide additional income to the lower tax bracket earner at that stage, then you will have a greater income because there's less tax paid back to the government. Now let's take a look at some examples on the 4 types of structures when it comes to maximizing tax and the implications behind it. Example number 1, let's say that you have an income of $80,000 working full-time throughout the year, and your partner is working part-time earning $30,000. You decide to sell one of your assets, and the property asset itself makes a profit of $50,000. What does this look like? So what I'm going to do is break down your income of $80,000, your partner's income of $30,000, and then the impact that the $50,000 profit has on the situation, how that looks like from an income maximization perspective or a tax minimization perspective. You have an income of $80,000. This means that you have a tax payable amount to the government based on our Australian tax laws of $16,467. So your annual net income at this stage is $63,533. Your partner has an annual income of $30,000. They're on a lower tax bracket. They have a tax payable amount of $2,242. Therefore, their annual net income is $27,758. So combined for the year, you have a total household income after taxes of $91,291 and a total tax payable of $18,709. So what happens if you own the property in your own name outright and you sell it and make a profit of $50,000? Well, you would be subject to the capital gains of the asset, and therefore, assuming that you've held the property for more than 12 months, you're entitled to a 50% capital gains tax. That means that you would only pay tax on half of the profit that you made from the sale, therefore paying tax on $25,000. You can see that it adds into your individual tax statement. Your gross taxable income has increased from $80,000 to $105,000, increasing your tax payable amount to $24,592. And your total household income is now $133,166. If, however, the two of you in a partnership owned that property 50-50 and you sold it for a profit of $50,000, half of the profit would go to you, the individual, and your partner, also the individual. So in this case, you're still both entitled to the 50% capital gains tax discount. Now you have a benefit because the lower income earning partner has additional income coming in at a lower tax rate that they pay the monies on. You can see that the total household income has increased from $133,000 to $134,800, and your tax payable has reduced by $1,687, a much better result. This is because a portion of the property that you sold is in the lower income earning person's name. Now, what happens with a trust? And we talked about the ability to distribute it as you see fit and maximize the opportunity to make the most amount of money for your family unit, reducing the amount of tax that you make. In this example, all of the $50,000 profit from the sale of the property would go towards the partner with the lower income. The idea is that you want to balance the incomes. So the original $30,000 income plus the $50,000 from the sale goes to their income, giving them a gross income of $80,000. However, trusts are also entitled to the 50% capital gains tax. So they only pay tax on $25,000 of the $50,000. What you can see here is that the net position is that your income for the household is increased from $133,000 if you owned it in your own name to $135,000 owning it in a trust structure. That's because you can distribute the earnings beneficially to maximize your net income and reduce your total tax bill. What happens with a company? Now, a company is not entitled to the 50% capital gains tax, and so it is a much worse position to own real estate in a company and sell real estate in the company in this particular example. Your total household income would reduce from $133,000 to $127,500, and that's because you have to pay tax on the full $50,000 amount and not $25,000. Let's take a look at example number 2. We're going to shift the numbers around a little bit. So in this example, you now have a working income of $110,000, and your partner is now a stay-at-home parent and they have no income for the year whatsoever. So you still have a total gross income of $110,000. There was the 80 plus 30, and now it's just 110. But you still decide to sell the property for a profit of $50,000. How does this look in comparison? What you can see here is there is a $7,500 benefit for using the trust structure over the individual, and there is a $4,500 benefit for using the partnership. And the tax brackets for the Australian government incrementally increase as your income increases. What you can see here is by distributing all the profit to the lower income earner, you get an incredible tax saving. Interestingly to note, you actually have less money under this circumstance than you did the previous example. And that is because when you had $80,000 and $30,000, you were earning more money at a lower tax bracket when you split the profits of the sale from the property. Okay, let's take a look at example number 3. In this example, you have an income of $80,000 and your partner is back to a $30,000 income. But we're going to switch it up a little bit, and instead of selling the property, what we want to do is keep it because it provides you with an income of $10,000 for the year. What does this look like as a tax maximization perspective? In this example, there is no capital gains tax discount because we haven't sold the property. So the income distribution now is solely taxed at the marginal tax rate of the individual. If it's in your name, you're on the maximum tax bracket. Therefore, you're not getting the maximum tax savings that you can for your family unit. If you split it as a partnership, some of that money goes to the lower tax earner, increasing your tax savings and giving you a little bit of extra money for your family unit. If instead you purchase it in a trust, you can distribute the entire earnings to the individual that's on the lower income tax bracket, maximizing your tax benefits to $1,350 by keeping the real estate. What you can see here in this example is because there is not an unfair advantage of the capital gains tax exemption coming in for the structures other than the company now starts to have a benefit. It has a $500 per year benefit over the individual. And that's because companies pay a flat tax rate of 27.5%. Having seen the 3 examples, you've noticed that in all of them, companies have not been the most effective method for reducing tax. But when is a company optimal? A company becomes extremely optimal when the individuals in that partnership have a tax rate higher than 27.5%. And you do not sell the property. Why is this? Any income that the company earns over the course of the year is taxed at a flat 27.5%. If you individually are paying more than 27.5% tax, the company tax rate reduces it back to 27.5% for any additional income. However, it only becomes effective if you're not selling the property, so you're planning on keeping it. Because as soon as you sell the property, every other structure is entitled to the 50% capital gains tax discount where the company is not. Let's take a quick look at an example that benefits the company over the other structures. In this example, you have an income of $80,000 and your partner is working full-time earning $60,000. Instead of selling the property, you decide to keep it in your portfolio because it makes you a $10,000 per annum profit. So now what you can see is that the income, if it was in your own name, makes no tax benefit towards you at all. You pay a tax rate higher than you would if it was in a company structure. In the partnerships, both individuals are earning more than the company tax rate of 27.5%. And so there is no benefit for splitting it in the partnership either. And for a trust, you can split it whichever way you like, but once again, the individuals are still earning more than 27.5% at this current income rate. However, the company is still earning a flat 27.5%. So now, for this particular year, if you decide to keep it, you get a $500 per annum benefit based on this example alone. So what conclusions can you come to from what we've just talked about? The first conclusion is for the individual, it's the least effective ownership structure for tax effective purposes. You do get access to the 50% capital gains tax, which is a benefit if you're planning on selling something. For partnerships, it does provide some tax effectiveness because at some point, somebody in the partnership is going to be a lower income earner than the other one. Any sale or profits that you make from any assets that you own automatically are put into the lower income earner's name, giving the family unit a better tax effectiveness than the individual. For the trust, this gives you the maximum flexibility to be able to distribute profits to any of the individuals as you see fit, and hence it has the fantastic tax effectiveness for both sales and income if one of the individuals is earning less than the 27.5% for the income side. And because it has access to the 50% capital gains tax, it's an excellent structure for the purposes of buying something to sell it in the future. And companies, well, they're not really effective for purchasing assets for the primary purpose of selling it in the future. They are very effective for reducing tax by holding onto long-term investment assets that provide an income. They do not have access to the capital gains tax benefit, and therefore the sale of a piece of real estate or asset in this structure is ill-advised. I just want to thank you for hitting that like and subscribe button. It really means a lot to me. But before I leave you, I'm going to make available my spreadsheet that I use to demonstrate the benefits of the individual partnership trust and company so that you can use it yourself. And I thought I might just quickly run through how it works for you. So, as you can see here, I've effectively simplified it. So all you have to do is type into one of these 4 yellow boxes and everything starts to work things out for you automatically. If you look at yourself and go, okay, what's my gross income? You can put any numbers down. It automatically works for all of the tax situations in Australia. So if you look at the gross income and you go, hey, look, you know what? I want to earn $120,000 for the year. So you type that number in. It starts automatically tabulating all of the aspects from the tax situations for the $120,000 income. Over here on the right, it shows you what the tax owed situation is. So the lower the bar, the better it is, because there's less tax, meaning you maximize your income. If you then go, well, what's my partner earning? And you go, okay, well, they might be earning $50,000 for the year, and you can see what that situation is doing. Now, the only 2 remaining fields that you can see are either any asset income that you receive or any capital gains that you receive. So if you sell something, it goes in the capital gains section. Now, you might sell something and make a phenomenal profit of, let's say, $400,000 for the year. And this starts to align things to help you understand which structure will be able to distribute under these earning circumstances for your family the best possible way. But equally, you might go, well, you know what? I might not have sold something this year, but I might have an income of $30,000. What is the best structure to use to maximize my tax effectiveness if I had an income of $30,000 from my assets for the year? And this would start to tell you which is the best way to do that. And the wonderful thing about this is you can still earn an income throughout the year and sell one of your assets. And so you can actually have that situation. And you might sell your $30,000 income asset and make a $200,000 profit and go, well, what does this look like? And which structure should I use to maximize that effectively? And this will tell you which is the structures that you get the most amount of benefit for. I hope you find some use in this, and we'll see you on the next one. Thanks, guys.